Hey, greetings and welcome to the May 2021 Investment Strategy Brief. I'd like to start with a review of the ongoing strong recovery. And it's really, in some ways, what we had in our outlook for 2021. So it's sort of playing out. Our base case was positive, the idea that the vaccination programs would go well. We'll get into that a little bit. And things are going pretty well. Obviously, the federal government has offered lots of support, fiscal packages and monetary policy from the Fed. We still have in mind the bull case, even though it sort of leans that way. It has leaned that way, meaning that things are going pretty quickly, but also the bear case, a delay in vaccinations, etc. And in particular, what we're interested in watching is this sort of closure towards herd immunity. Are people hesitating to get the vaccine? That's going to be an open issue. So that's one of the risks we're watching is sort of, does the vaccination program lose its steam here in the U.S.? We don't think so. We think we'll get there. But the other things that are out there, of course, are variants on the virus. We were going to talk a bit about sort of market valuation and whether we're in any kind of level of excess here. And then it's been in the news for a number of weeks now, the idea of heating up inflation heating up, and that triggering higher rates and Fed action potentially, or maybe Fed action than higher rates. So we'll see. Anyway, so there's some of the risks we're monitoring. Now this month, we want to focus in a little bit on one of our longer term themes, the fourth industrial revolution. So I'm talking to clients a lot, and one of the questions we get pretty often is, how are we going to work our way through all of this? And at the end of the day, especially here in the U.S., we have a great system, basically a system where people are working really hard to innovate. And in today's world, of course, that's sort of amplified by technology. And so the idea of the fourth industrial revolution, which was coined by the World Economic Forum, is that we're actually in this phase of rapid and impactful innovation, much driven by technology. So we'll get into that a little bit. But first, let's take a look at the pandemic, kind of where things are. And I mentioned the idea of the vaccination program going okay, but slowing down a little bit. The chart on the right side of this page kind of tells that story. Those sort of very thin bars on the right show that we peaked just over 3 million a day. And in the last couple of weeks or so, basically we've settled down to around 2 million a day. And I think we all see it, right? All of a sudden, the communication has gone from wait your turn to a marketing program to get people to go and get their vaccines. And so again, we're sort of moving into that population that's not 100% certain they want to do it. And that means there's a lot more appointments available, but then in turn, we need to get people, at least a decent number of the rest of the population in there. Now, the other thing, of course, we're watching is actual infections. And this dotted line's just been moving from left to right here on this page. And we're moving through time and basically seeing the daily infections declining. That's what we want to see. And so we'll kind of get into that in a second in a little bit more detail. Here is basically a snapshot of sort of how people are doing in terms of the percent of population that has gotten at least one shot and then fully vaccinated. And you can see different countries here. Israel, we've talked a bit about. And then down the page is the U.S., second from the bottom of this list. But we're doing pretty well. Basically, 46% of the population has got at least one shot. If you couple that with the number of people that have probably been infected and have antibodies from that, we're probably hovering around 60% overall herd immunity, immunity. So we'll see if that translates to herd immunity. Now, I mentioned that we'd go into sort of the U.S. here in a little more detail. This is just a little bit more zoomed in chart. And here you can see the kind of the new cases, confirmed cases. It's the blue line that's been declining. So we're down, just above 30,000 a day. It peaked at 250,000. So that's quite a big reduction. And then you can see the percent of individuals that have gotten at least one shot as the green line. So what we want to see, of course, is these two lines continue to move apart. Meaning that more people get vaccinated and fewer cases are seen day to day. So again, it's the kind of data that we're watching very, very closely. Another thing we check in on each month is sort of mobility, and here you can see a lot of things are moving again in the right direction, where people are kind of re-engaging in retail and recreation. They're re-engaging in a variety of things. I would say the workplace thing is still a little bit more slow moving, meaning people are taking their time to go back to work if they're working remotely. But we expect that to close basically over the summer. You're hearing all kinds of sort of stories, reading stories about companies developing their plans to get back. And even this idea that the CDC recently, issued new guidance saying that vaccinated individuals don't have to social distance, don't have to wear a mask indoors or outdoors, still on, buses, trains, et cetera, planes. But that's good news. And of course, each state is going to take that guidance into account and then slowly evolve their policies. So again, we think the reopening is going fine, and, we'll kind of keep monitoring that. So let's get to the fourth industrial revolution and start with, again, a reminder of what this is. So the idea of the integration of technology through digitalization that's really blurring the boundaries between our physical and virtual world in such a way that it's really changing the way we live, we work, and we do business. And so this page just shows a bunch of different things that relate to this: 5G, wearable devices, 3D printing, quantum computing. There's just so much going on, and it really is sort of just changing our lives very, very quickly. One way to kind of take a snapshot of that, I'll start on the right side of this page, looking at data and sort of the amount of, I guess they're called zettabytes, just lots and lots of data kind of being created in our world that can be used, right, to analyze things and help with our lives and help us kind of do what we do. But the other snapshot to take is to look at how the world's changed over the last 10 years. So this is year-end 2010 versus year-end 2020. When you look at the top 10 companies in the world by market cap, how big they are in terms of valuation, you can see that, a decade ago, things were very different. A lot of oil companies there, for example. When you look at 2020, basically 9 out of 10 names are sort of tech-oriented companies providing, just a variety of services and really sort of at the center of this fourth industrial revolution. So that kind of tells the story in a nutshell. Now, some things changed as a result of COVID. We've talked about this before, but the spirit of it is to say, like, hey, when we got into COVID and the shutdowns, that meant people had to kind of lean on technology a little bit more. So things like, let's go through a few. Individual screen time. That's whether it's children or adults, people are sort of staring at their phones or sitting at their desk, whatever it might be. They're basically engaging a lot more with devices. We saw internet traffic when you think of the peak in any given year and how it's moving. When we look at the peak of 2019 to the peak of 2020, that traffic grew by 50%. Another thing that gets tracked is, hey, when you're ordering something, I ordered something earlier this week, basically clicked at about 6 p.m., and the thing was at my door at 11 a.m. the next morning. And so that click-to-door time is really falling. And in any event, I think a super important one is e-commerce. Basically, one thing that people have been tracking is the adoption or penetration of e-commerce in terms of the way we engage in basically our purchasing. And essentially what we saw, of course, in 2020 with the pandemic was a big jump in that. But let's look more out to the future. When we look out about 10 years from now, 2030, it was forecasted before the pandemic that e-commerce would have about a 22% penetration in terms of commerce. Because of the pandemic and sort of the learning that went on and the awareness, that has jumped to 34%. So by 2030, a good third of the commerce that gets done will be done digitally. And that, that's a big move, obviously. It means a lot to things like in-person stores, et cetera. Now, one of the companies that we read a lot is a group called Capital Group. And they, they're investment managers and very, very, very capable people. But one of the things that they recently talked about, and they tend to be long-term thinking, is to look out 10 years from now and how will the world be changing as a result, or changed then versus now. It's almost like that forward look a decade from now. And much or almost all of what they're talking about is really fourth industrial revolution driven. So take, for example, healthcare. The idea of things like virtual monitoring, so people have conditions, you can set them up with wearable devices, and then have the monitoring automated, and alerts go to doctors or the individuals, or if it's a child, maybe their parents, to say, hey, something needs to be attended to. There's a view that we're making great progress in the cure for cancer. There's a view that digital forms of payments, so paying with your phone, for example, instead of handing cash around, will be even much more present, and where cash really will be increasingly not used. Semiconductors will be everywhere and in everything, meaning, hey, the wearable devices, everything that you might have could have a semiconductor in it, and maybe monitoring of it or by it in terms of things going on. And then, wearable technology will sort of blur the lines of reality. There again, I think the idea is that, you're going to end up sometimes with this sort of view that we're looking at things, could be shopping, or you're looking at sort of augmented reality, things like that. Now, we saw in 2020 with the shutdown of theaters and things like Broadway, the idea of digital entertainment being more focused, that will just continue. 10 years from now, it will really be the center of what we do. And then I'll close on this page really just talking about transportation in terms of vehicles. So 10 years from now, the view, a lot more autonomous vehicles. So basically self-driving vehicles, probably driving people around, and many of those will be essentially green, meaning, powered with alternative energy. And so, again, we'll watch all this unfold and see where we are. But the spirit of this is to be mindful, even as we're investing, that innovation is going to happen, and where will we be a decade from now? Okay, so as it relates to innovation, here's a couple of data points to watch, right? One is patent application, so who's looking to sort of secure their intellectual property. And then a second is, as an economy overall, how much are businesses spending and government spending on research and development, which can be measured as a percent of the country or region's GDP. And what you see here is that, and not surprisingly, that the U.S. has been pretty dominant. So here we're looking at the U.S., China, Germany, Japan. But boy, the chart shows that China's fighting hard to catch up and basically pass us in terms of this kind of innovation. So from a competitive perspective, that's something we're watching very, very carefully. So with that as a sort of a backdrop, that fourth industrial revolution backdrop, let's turn to the macro environment. Recall this rather dense page is just sort of our under the hood look at some of the things we're watching. So I've mentioned inflation. We're watching the rebound, right? Manufacturing, things like that. There's nervousness in the market. Mentioned inflation as an example, as a potential headwind, but it's also causing nervousness and increased volatility. As mentioned, one of the themes we're tracking is fourth industrial revolution. And then those headwinds include the idea of inflation and people getting nervous about that, maybe some slowing down of the vaccination program, people being worried. It really comes down to confidence. But of course, the tailwinds include, so far, a successful program in terms of vaccinations, a very strong recovery, evidence we're going to have a very strong rebound in the economy here in 2021. And, the idea that the reopening is still, in some ways, just beginning. And so there's a lot to be positive about looking forward. Now, turning to some of the data on the economy, I've always talked about this page as related to sort of a lot of data, but color-coded and sort of presented so that one can take a quick glimpse and see what's going on. And boy, what you see here on a few of these measures is some pretty dark green, which really just is signaling that relative to history, some of these metrics are recovering. And so you can see things like GDP now, or personal spending, or consumer confidence, but especially industrial production, and the composite purchasing managers index for market, basically very positive numbers. On the flip side, of course, as mentioned, we've got inflation kind of looming. And in fact, we look at this next slide, a variety of different measures. A couple of the more traditional measures have really popped up well above 2%. So consumer price index and PPI, so CPI and PPI, both up well above 2%. And that there's a view that that's sort of transitory. We'll get into that in terms of the Fed's impressions in just a sec. But But basically, even when we looked at the 5 and 10-year break even, this is using TIPS bonds and nominal bonds and looking at how they differ to infer a forward-looking inflation rate from the market's perspective, those owners of those bonds. Basically, you're seeing a little above 2.5%, 2.6, 2.7% is the anticipated inflation over the next 5 to 10 years. Not so far above the Fed's 2% target that we think that they'll have to act, but something that everybody's watching very closely. Now, in terms of the recovery, of course, one of the things we're watching carefully is jobs, basically, and employment. And while we're sort of hovering at what has been the long-term unemployment average of just over 6%, it's still, when you zoom in on industries that have been really impacted by the pandemic, there's a lot of job losses and a lot of recovery to be done. The most obvious in some ways is the leisure and hospitality, where over 8 million jobs were lost. We're now at 65% recovery of those jobs. But you can see things like trade, transportation, et cetera, recovering 77%, and education and health services maybe a little bit slower, recovering 59%. But everything's moving in the positive direction, which is good, and again, something that we're monitoring pretty closely. So speaking of the Fed, then, essentially one of the things that's interesting about the Fed is there was a period of time where they were, what's the right word, sort of taking their time to interpret and consider the vaccination programs in their outlooks. It's sort of like, hey, they wanted to see it prove out a little bit, and they wanted to see the program prove out a little bit. But they've upgraded their outlook really as a result of the success of the vaccine programs and the reopening that's going on. Their messaging, though, is essentially three things I'll mention. Number one, there's still a long way to go for them to, quote unquote, fulfill their dual mandate, keeping prices under control, but maximizing employment. So they're focused on employment. Number two, they see inflation higher in the very near term, but view it as transitory or temporary, meaning it's probably driven by a surge in demand, maybe driven by supply shortages as people reopen, but they expect it to calm back down. And as a result of that, they plan, number three, to keep their interest rate, their benchmark Fed funds rate low for a while. That's their forecast at this point. So the Fed tends to be optimistic. Now, I mentioned that confidence is something that's super important, both on the business side, we see that in purchasing managers indexes, for example, but also with the consumer. The consumer basically drives 2/3 of the economy. And essentially what we've seen is a nice recovery in consumer confidence, number one. Number two, we're seeing a massive rebound in retail sales. Now, about a year ago is when the pandemic really hit, so things softened a lot. So the fact that we're seeing big numbers in part is because of what's called a base effect, meaning that base was reduced from a year ago. But still, significant strength in retail sales. Savings rate is up a lot by historic standards because of the checks to individuals from the government support. And then, as mentioned, the unemployment rate has been declining, bumped up a little bit this last time around as new jobs were sort of put out for hire. But basically, 6.1% is exactly the 20-year average when we look back over the last 20 years. So still more room to go for sure, especially back to that 3.5% level that we had pre-pandemic. But we do expect that to continue in terms of 6.1 declining. Now, one of our Stifel companies, KBW, has a restoration index, basically a real-time index capturing the recovery, captured the closing of the economy back in the early part of 2020. And you can see here what I like to describe as sort of just this methodical march back towards 100. We're not there yet, but by the restoration index from KBW, we're making progress, which is good news. Now, this all sort of comes together in a forecast of the economy from a macro perspective. And what we see here is sort of the result of, in the last, call it 6 months, all the quote-unquote experts out there and firms that track the economy and that rolling up to a consensus, all of that basically rising so that when we look at 2020, sort of that spread that we're seeing is everybody sees GDP this year up between 6 and 7%, which is a very strong, recovery, once we actually had GDP decline 3.5% last year. And so, bottom line is this is super important as the reopening occurs. There's a lot more consistency in outlook. People are always mindful of what could cause a disruption, but so far, things are going okay. And again, you see some positive views here for the balance of the year. Now, you hear me talk from time to time about risks. I think one of the things that's challenging at a group like ours is that we are almost tasked with looking for problems. Let's look around and try to find the risks that exist in the system and gauge, okay, number one, what's the chance that this will happen? Number two, if it does happen, what's the impact on the economy, the markets, et cetera? And so this is just on this next page, just a bunch of things that we're watching very, very closely. A lot of it we've talked about as it relates to inflation and kind of that bubbling up more than expected. Also, I think there's worries, of course, about sort of the vaccination program and the pandemic, the virus itself, whether we'll see variants, et cetera. But again, when we add all this up, we remain, at least modestly positive looking forward in terms of the economy and the markets, in terms of things not, kind of declining from here too much. And so, again, I'd say the overarching work is to dig around, look for problems, but right now things seem to be holding together pretty well. And that's reflected in the market. So, we looked last year, of course, at 2020 and had a strong bear market as people got spooked about the pandemic, and then a strong recovery as we figured out that there would be a path through it. In 2021, basically, we've had some volatility, but boy, when you look at year-to-date numbers, things are pretty good, in terms of the S&P 500 up almost 12%, and like the Russell 2000, that smaller cap stocks up 13%, and then even, non-U.S. markets, et cetera. Just markets around the world, everything's holding up okay in terms of a decent year for 2021 so far. We've had some volatility, but things are holding up. As it relates to rates and spreads, of course, I mentioned that the Fed is expected to keep its Fed funds rate low. Interest rates in the market, though, as measured by Treasury yields, have increased, and the curve has steepened. That's helped things like financials, and we'll get into financials in a second. I mentioned the 10-year break-even inflation rate has been rising, but that corporate spread, which is sort of a measure of the market's interpretation of risk, has been narrow, which means the market investors in that space feel pretty good about things at this point. Now, here's a super interesting analysis, page 31, that basically is take a little bit to explain this. If you take a 60-40 portfolio, 60% in equities, 40% in bonds, and you sort of say, look, I think yield is a good way to gauge forward return from here. Essentially, you can take the PE ratio of stocks and flip it around and get an earnings to price yield. And that's one way to think about a forward sort of yield that you get on equities. So dividends plus other earnings divided by the price. And then you can look at the actual bond market yield. Long story short, and it's a lot because interest rates are so low right now with the Fed, et cetera, we're at historic lows in terms of that forward-looking yield in the 60-40 portfolio. So that's something we're mindful of, and it causes us to sort of mute and forecast our longer-term returns just a little bit lower because of things like this. So something to consider. Now, I mentioned financials. One of the trades that we talk about a lot and others talk about a lot is value versus growth. Last year was all about growth. This year it's more all about value. But what is notable is that really there are two sectors that drive this relationship. Financials in the value sector, so the financials are overweight in value, and tech in growth. Tech is overweight in growth. And so what you see here is it's almost like where goes the financials versus tech relationship, so goes value versus growth. And so again, I mentioned, for example, that steepening curve. Essentially, it's a good environment. Interest rate environment's good for financials. The recovery is good for financials, and that's been playing out in the market performance. Now, earnings more broadly, one of the things we've talked about for a number of months now is this increasing optimism and increasing recovery, if you will, in the earnings of stocks. And so here you can see, and I'd focus in on the gray line that is capturing the first quarter 2021. We're almost through with all the reporting that's going on, but the bottom line is, by that line going up, that's a signal that things are better, much better than were sort of first forecasted by the market. And so again, I think the nice thing to mention is that we're in this period of recovery, and that's translating to company earnings. It's obviously important for stock valuation, among other things. Now, another thing we all track is, well, we're in this low inflation environment. We've been in a low inflation environment, I should say, and now inflation is rising. So one of the things people are able to do is say, well, hey, in that kind of environment, let's look at how different capital markets perform. So the lower left of this chart is sort of the environment we're in. So when we look back in history, you can see, generally speaking, a positive return in different capital markets, and equities overall up well. Interestingly, for the longer term of these kinds of environments, growth a little bit better than value, but just a little bit. And then emerging markets eventually kind of recovering. Those are sort of the riskier part of the non-US market. But even things like high yield and bonds in general have performed well. So we don't just look at history and say this will happen again, but this kind of historical analysis definitely informs the way we think about the current environment, where things are going. Now, all of this translates to dynamic leanings. We've talked about it before. We have a framework where we help our advisors and our clients think about asset allocation, one of the most important decisions. But at the end of the day, some folks will invest strategically, meaning, hey, I'm just going to go 60-40 and rebalance that from time to time and not worry about it. But others like to sort of lean into or out of markets, either to protect a little downside or take advantage of maybe misvaluations and earn a little extra return. So that comes through in what we call dynamic asset allocation. And just to reiterate, some of our leanings here in 2021 were modestly overweight non-US. We expect that part of the market to come back a little more strongly than it has so far. Within the US, we're overweight small cap, and that's been a positive as we've seen small caps outperform in this recovery. And as mentioned, between value and growth, we're overweight value. And that, again, has been a pretty common view and a common trade, and from a return perspective, it's playing out pretty well. Now, I've talked a lot about inflation, and on the fixed income side, we're overweight inflation protection securities, or TIPS, if you will, in the fixed income market, and that was put on to sort of hedge that little bit of the portfolio against inflation. And then we've been overweight high yield, really with the guidance to use active managers, because even though overall high yield has performed super well, which has been great, it's also a sort of a risky segment. And so it happens to be the kind of environment still where active managers can add a little bit more value. So we've been overweight high yield with active management. I'll close by just reminding everyone this body of work is available for anyone that wants to check it out. Page 40, if you're looking at the slide deck, is a bunch of live links to this work. It includes this video series, a podcast that relates to it, and then a bunch of other work that we are happy to provide and hope you find helpful. So thanks so much for listening or viewing this month, and we'll look forward to talking to you again in June. Thanks so much.